Hi, welcome to Let's Talk Bond, the bond market podcast from INR Bonds. I'm Arjun Patsati, and today we have a very interesting topic and also a very interesting and esteemed guest on the podcast. The topic is very clearly as stated here, which is high credit spreads, whether it is an opportunity or risk. What does it present to the economy and for bond investors and for the market as a whole, including equity markets? And our esteemed guest is Mr. Venkat Srinivasan. He is a bond market veteran, with decades of experience, both in the markets as well as in helping companies raise funds. He's an expert in that, in terms of working with companies and helping them reach out to investors and raise funds for their investments and capex and working capital and everything else that is required. He till recently, till 2021, he was working with ICICI Securities, the primary dealer, and working in the capacity of heading their origination business, that is a DCM, debt capital market business. And after that, he started his own venture, Rockford LLP, Rockford FinCap LLP, which is into advisory. He advises treasuries and companies in their funding requirements and all other aspects of their market borrowings. Also, he is a very active in propagating information on bond markets, propagating knowledge on bond markets, and he runs a very active groups in Telegram and social media on propagating information and knowledge on bond markets. He is also independent director with other companies, and like I said, works with many advisors. Thanks, Venkat, for agreeing to come on this call, and look forward to sharing our thoughts and our views with our listeners.
Thanks, Arjun. Thanks for inviting me for this podcast. I'll be very happy to share my views here. Thanks once again. Yeah.
Yeah. So without much ado, let's get back onto the podcast, on the main topic of the podcast. Just before that, our investors should understand that bonds carry credit risk, which is risk of default, interest rate risk, where prices can go up and down, and also liquidity risk. The impact cost of buying and selling can be very high. So investors should understand this risk before taking any investments in bond markets. Coming back to our topic, high credit spreads. Okay, now what are credit spreads? Credit spreads are the difference between a credit risk, a bond that carries credit risk, and a risk-free bond. So the what bond is risk-free is the Government of India bond, because the government can print money and repay investors. So it's called the risk-free bond. And any other bond carries credit risk because there is a risk of default. Now, when credits, so basically the thumb rule here is that when the credit spreads are low, that means there is lower risk of default, and when credit spreads are high, there is higher risk of default. It's as simple as that. So then these credit spreads keep moving up and down, depending on the market perception of risk. So you can compare it similar to, say, valuations in the equity market, where high valuations means that the market is giving a lot of prominence to growth and the economy is doing very well, and low valuations mean showing that it's a depressed market. And normally in the equity markets, investors, very knowledgeable investors, do tell you to invest in when markets are depressed and sell when markets are too optimistic. Now, coming to the same credit spreads, whether that holds true, that's the point of discussion here. And just to take you through a bit of data, right? So INR Bonds Retail Bond Index, it's a bond index of eight bonds from bond issuers from AA to A minus. This index we started in Jan 24. It's a 3-year constant maturity index. And the index when we launched it was at 9.5%. In that last 18 months, it's moved from 9.5%, went up to 9.8%, it's back to 9.5%. In the same time, if you see, take the 3-year Government of India bond or the 10-year bond, the yields have moved on at least by 100 to 125 basis points, 125 or 130 basis points. So clearly, while the Government of India risk-free bond yields have moved down, the yield on the high yield bond index has hardly moved, which shows that the spreads have increased. That means, technically, in our parlance, it says that the markets are factoring in a higher risk of default in lower rated bonds, while the probability of default can be low, high, depending on the issuer and the spread and the other aspects of the financials. But in theoretical fundamental terms, what it typically says is that our high yield bond index is showing there is higher risk of default. Now, there are two aspects to this. Like I was saying, in equity markets, they say that you invest when markets are low and sell when markets are high. So, in credit spreads term, does it make sense for investors to invest when spreads are high and sell when spreads are low? Or is there more risk than what we can see, or credit spreads telling us something? In this regard, Venkat, I would like to share you to share your thoughts with our listeners on what you believe is the reason for this.
Yeah, hi. See, you are absolutely on track. Now, what has happened currently is that the banks have been very slow in transmission, as also accepted by the governor. It says that it will take transmission generally takes between 6 months to 9 months, and and also the credit spread has gone for most of the BFSI companies as such. If you see, that could be one of the reason earlier the RBI has increased the risk weightage on banks lending to NBFCs and unsecured loans, and now it has reversed. At that time, people have left with little bit choice to get into the bond market even at a higher spread. And even today, if you see, banks have been very having a risk aversion of lending any additional funding to such entities, or even for some manufacturing companies, low rated manufacturing companies per se. So of late, you would have witnessed that more and more companies of BFSI sector are on a lower rated manufacturing companies are either tapping money from NBFCs, or they are been approaching, if they need a larger amount, they have been approaching private credits also to get their funding, etc. So on that basis, if we see that, currently you would have noticed that there are a lot of AA companies also tapping the market, maybe for acquisition purposes or refinance purposes, or a normal working capital purposes or business purposes. For example, if we see that Jubilant Group has raised funds sometime back, and Vedanta has raised, funds sometime back again, and today we are seeing Piramal Finance have raised funds. These are all the AA categories. And if you see the level vis-a-vis compared to the AAA levels, these people were able to raise good funds actually. There are good appetite is there from between 875 to 9 quarter. This is the range they have been borrowing funds as such. If you compare to AAA, it's approximately somewhere, I would say, 175 to 250 basis points spread, which they are able to rise. This is for AA I'm talking about.
Venkat,
Uh,
can I just interrupt you? Were
yeah.
banks doing lazy banking, as in, see, they knew that rates are going to come off, and so the best way to is to invest in government bonds or AAA PSUs and corporate bonds. Because if you look at the spreads itself, the spreads of AAA PSU and corporate NBFCs and AAA NBF PSUs have come off sharply, along with GSEC yields. But so there was no incentive for banks to go out and take in a little more extra risk in terms of lending to lower rated. But now, will the transmission be faster?
The transmission, according to me, will take some more time. It is not going to happen immediately. According to me, it will take at least 4 to 6 months time lag. Even if they want to hurry up, they may be at least 3 months to give the full transition. and it could be differ from banks to banks. It depends upon how banks want to transmit these rates to their borrowers. It all depends upon that. And also, if you see that uh, you know, if you see the levels as such, the MCLR rates and the EBLR rates are still very much on the higher side. Even if a 1 year MCLR we talk about, it should be somewhere around 8.75 to 9%, and EBLR it will be somewhere slightly being lower, or 50 75 basis points below. But if you compare with the AAA corporates, AAA will definitely prefer bond issuance only, even post policy. After changing stance, the yields have gone up slightly, but still most of the people are tend to go back to the bond market only.
Venkat, could you just explain to our investors what is the full form of EBLR and MCLR, just for their own
Uh,
understanding?
No, no. See, this is the bank lending rate, marginal, lending rate for banks, the normal loan that you are giving to the company, and yeah, EBLR is that external benchmark, whether they go through, 3 months repo or a 3 month treasury bills. They can keep any benchmark as such, and with that they have a proper spread and give it to them. So those things also generally, EBLR etc. is going to be very very competitive. Used to be very very competitive earlier, where each and every institution is go to banks for a EBLR kind of rates only, because generally MCLR is always on the higher side. On that basis, they have been, most of the entities are trying for, MCLR and EBLR. But of late, I've been informed that banks prefers to give loans on MCLR only rather than giving EBLR X for AAA rated companies. So that is also gives some kind of discomfort for the lower rated entities, that if MCLR plus spread is going to be there for lower rated companies, the rates are going to be very high. And not only, see, if we, very frankly, if we speak, the rates of banks generally for lower rated entities are lower than the corporate bond markets as such. But the problem where it comes in is that the banks are being very slow in transmission of the rates, number one. Number two is that they don't, whatever, we understand that they have been very, very selective in giving additional loans or a fresh loan to the new entities. So that is creating a problem. So they are losing, most of the borrowers are losing patience, and they are shifting directly to either to the NBFC market for taking loans, or to the, credit market, or even for, there are a lot of online bond portals now is there, like INR bonds, where people try to help them out, and giving the money they require. So on that basis, they are trying to get additional funding for their day-to-day businesses.
Mhm. Okay. Now, Venkat, on this RBI, this recent policy in June, they had mentioned that they have infused 10 lakh crores of durable liquidity, plus another CRR cut will add on another two plus lakh crores of liquidity in the September to November period.
Yeah.
And so one would say that, I mean, if you take system liquidity, it's on an average about 3 lakh crores to a surplus going forward. But is there a sense at the banking system that this liquidity may not last? And will they be, they have already reduced deposit rates, but will they be reducing further deposit rates, assuming that this liquidity is going to stay high for a longer period of time? Or are they still worried about liquidity, going off due to fact that RBI forward sales is closer to about $60 billion, and if that comes up, and if they choose not to roll it over, then would that negate some of the system liquidity? Is there any kind of worry in that front, and is that the reason why the spreads are still high for lower rated borrowers?
See, as far as liquidity is concerned, according to me, I'm very sure that the current management of our Reserve Bank of India, it's very confident of giving durable liquidity to the banking system. And they have been very good in front loading whatever possible way to make sure that durable liquidity is there in the system. That's why the RBI governor also clearly said in the monetary policy that, I could have cut, 25 basis points of repo cut, and I could have announced CRR rate at that time. but he want the bank transmission to happen. That's why I announced, what are the liquidity measures I'm taking to take out the worry of the yeah, market as such. What is going to be there for the liquidity. So with this current system, in spite of the swap, etc., whatever has been accounted for, I'm very sure that at least they should be able to maintain 1.5 trillion to 2 trillion of consistently for at least for this year. Now, next year, if the inflation goes up, then we have to see how it is going to be. But at least for this year, I'm very pretty sure about inflation durable liquidity is going to be there in the system. But question is that whether it's going to be that, about 3 trillion or the, above 1 trillion to 2 trillion range, that has to be seen. But definitely, I presume that 1.5 trillion to 2 trillion will be the benchmark as far as I am concerned.
Fair enough. And now coming to the spreads itself, right? So normally the at such high spreads, I mean, if you take, for example, the spread of a retail bond index over the 3-year GSEC has gone up from 250 basis points to 400 basis points over the last 18 months. Now, there are two ways to look at this. Like I mentioned at the beginning of the podcast, that there is definitely a sense that there has been some excess growth and that is coming off. So bank credit was growing at 20% plus, now it's at 10% plus. I think to some extent RBI was playing a factor in that, trying to increase risk weights and all that. And suddenly they found that this has come down to 10%. The economic growth is looking to slow down. There's other external factors also impacting this, and they want them to increase. Maybe that could be one reason, or also the other reason is that obviously in the MFI sector we have seen definitely overgrowth and overlending, and all that is getting corrected. Now, is this any indication, the credit spreads of an economic downturn, as in not really a very sharp downturn, but a lower growth for a longer period of time, rather than forecasting some kind of a higher growth, despite RBI trying to, pump prime the economy through front-loaded rate cuts and liquidity.
See, according to me, the economic growth, as I have to go along with in line with what RBI said of 6.5%, and if not more, actually, they even though RBI prefers somewhere around 7%, 8% kind of a growth, but currently we are at 6.5. I think they should be able to maintain 6.5 as of now. I am not expecting too much of a decrease from those levels. In case of anything is there, I'm very sure that. RBI will try to take adequate measures as and when required in case if they want to pump in liquidity. That's what he said. The change in stand to becoming neutral is that, in case if they want to increase the rate, they can increase the rate. In case if you want to decrease the rate, they decrease the rate further, and they can do either VRR or VRRR. Everything depends upon the data. So it is all data driven. So I'm very, very sure that RBI is monitoring all this data on a day-to-day basis. And if required, I think they will pump in further liquidity to boost economic growth.
Right. So coming back to the main topic itself, in your own sense, do you see these high credit spreads as an opportunity for investors to lock into rates right now, and if their alternates is very low rates in terms of both falling FD rates and government bond and other high high safety rates, right? Or is it prudent to calibrate and wait for some time before they want to start looking at higher yielding credits?
See, most of the investors must be knowing about that even FD has got as inherent risk. Even though we say that the banks don't default and everything, but is always been, that's 5 lakhs of insurance has been given for each and every account of banks in case of bank default. So, and banks FDs are also unsecured. It is all based on which kind of a bank you want to invest. If you, whether you want to put your money in SBI or other top rated banks or a lower rated banks where it gets you somewhere around 8% plus or 7.5% plus, something of that type, there also you have your risk is getting increased. So for you are ready to pay, you're ready to accept FDs. Say if it's for example that if SBI is giving you 7%, I have not checked the current FD rate, sorry. But if a lower rated bank is trying to give you at 8%, that means there itself you're trying to take some kind of a risk on a FD itself. From AAA rated banks to we are going to A rated bank, something of that type. That is absolutely, I understand that as of today, FDs and etc. It is not defaulted till date, and RBI helps retail investors to get back their money. So that kind of a comfort you have. But what I mean to say that inherent risk is there in case anything can happen one day. Anything can happen on that basis also. So if anybody wants to have a higher return, they have to take a risk, because people, I am very sure people understand equity. They understand the risk in equity. They put money, even whatever happens, anything bad thing happens, even though even they lose their principal also sometimes. So that kind of risk already people are used to take it in equity. I would say why not in bonds? Because you have to see what initially I would advise people to go with a triple A NBFC or a double A plus NBFC, or even a double A rated instruments where you're getting a 9% kind of return. Where if currently we see that Piramal Finance has done a 2-year paper where it is giving a 9% kind of a return, which is very good actually. So what you have to see that you need to go for such a paper where you can take some kind of some percentage, not the entire amount they want you to invest, but you can go and try with some companies of some percentage, maybe 10% or 20% of your total savings into this kind of bonds. And also you have to make sure that you have to do some kind of a little bit of analysis, or the person who is marketing this kind of bonds can help you in getting the analysis, what kind of a rating it is that, and what is the, in case of NBFCs, what kind of AUM they have they defaulted in the last since inception on any rates, etc. So the basics things, if you find out, so that you have somewhat confident of taking some kind of a risk. And most of the people today, even the for example, the online bond portal also, they try and make sure to reduce the risk of the investors by structuring those bonds. For example, if you're looking for the bonds generally offered by such portals, online portals, are between 18 months to 3 years. They don't go beyond that, because to reduce the risk of the investors beyond a certain period. And also they try to structure the terms of the bond. For example, the interest is payable monthly, or a principal is payable monthly or a quarterly, so that the risk is getting reduced on a month-on-month basis. So it is all depends upon what kind of a structuring you do, and what kind of investors are willing to take what kind of a risk, and what kind of a rate you are willing to do at. For example, if you want to go for, if you feel that for me is 8% is fine, even a bank FD can give you an 8%. If you want to go for a 9%, and double A papers are available for you at 9%, something of that, 850 to 9%, something of that type. If you want to go for a below the double A minus, then the credit spread jumps, because double A and above basically are accepted by provident funds also, where you have very good demand, so the levels goes down drastically. But once you come below double A and below, these kind of entities of insurance companies or provident fund, etc., they're not allowed to invest anything below double A. Automatically the credit spread is rising further. It is not that inherent risk of that the credit spread is going because of other factors, but just because of the investor segment strings, the investor basket strings, automatically between double A minus and below, the rates automatically jumps up. So people should understand those things. If in case we want to go for a double A minus or a A plus kind of paper, where you get an opportunity to invest at 10% also. So it is depends upon how much risk an individual investors want to take, and what kind of a risk reward you want. Accordingly, they have to act. But definitely, they have to do some kind of a due diligence before investing. Thank you.
Right. Also, there are also a lot of now we are seeing, given that uh, the mutual that there are no tax benefit of investing in mutual funds. So there is a lot of movement into alternate funds, which are offering, many of the asset management companies are offering debt PMSs and AIFs that are wide range of higher yielding portfolios, where they are professionally managed, and many other aspects to the fund management that gives comfort to investors, plus give them a higher risk reward. My in this sense, the spreads are pretty high. I mean, the way I'm seeing, I told you the retail bond index spread is like 400 basis points. So you have spreads going up from 400 to 600 plus kind of basis points across from double A minus to A minus or triple B plus. And some of the companies, I mean, depend that really depending on the investors' risk appetite and all that, or if they have a good advisor, they are able to evaluate the risk and invest. Now, are these spreads? I mean, and these spreads have definitely widened. So, in your own sense, just looking at the spreads itself, are they offering a better risk return profile to the investor than if spreads were lower than these?
See, I would rather talk about a range of, triple B, double A minus to triple B plus. Definitely, the spread is, going up from somewhere around 250 to 600 basis point spread, definitely. As I said that even if you take companies like a triple B plus or A minus, there are some niche player who will be the market leader for the niche segment. So on that basis, because of the niche player, that rating may be lower, but definitely the risk will be much lesser. So, rather of going blindly of based on the rating, I would rather, prefer to invest in those entities. What is the company and what they do, whether they are the market leader in that particular segment, what kind of a AUM they have, and all other things, who is the promoter, and all other things, just instead of just looking at the rating. So that is very, very critical in case if anybody want to take a risk, irrespective of the spread, whatever is there, because spread can go come and down depending upon the liquidity. Maybe after 6 months you have to see whether spread is coming down or not, if bank is able to transmit the rate transmission to their lenders, to the borrowers, at a very good level. Even frankly speaking, as I told you earlier also, the actual level bank can offer is much below their bond rates. So the only thing is that if they're able to extend the loans further for giving additional loans, or they can able to quickly transmit the rates to their borrowers, sooner or later, if the bank loans comes down, automatically the corporate bond level also will tend to come down.
Fair
So
enough.
at the moment, I would see that this is the opportunity. Yeah.
Yes, I think that's a very, very strong point you made with the niche lenders, that is the leaders in that particular category of lending segments, irrespective of their rating and others. The second is that clearly what you're saying is that if the banks start to transmit the lower borrowing costs for their own, right, their own costs, lower costs to the borrowers they are lending to, then that could mean that the borrowers themselves, which is lower rated NBFCs and others, could see better risk profile going forward rather than what the spreads are saying now. So in one sense, the spreads are offering an opportunity. In other sense, obviously, the fact that if the risk aversion continues, there are other factors that are still hurting the economy, and the markets are still a little worried about what's happening globally. Then obviously there is a risk. But having said that, the spreads itself offer higher risk return profile to investors at this point of time. And yeah, so to conclude, can I say, Venkat, that at this point of time, at credit spreads, higher credit spreads offers good selective opportunities, provided that investors do enough due diligence or have advisors who have done their homework before telling them where to invest in, or they locate a good fund manager who invests in a portfolio of higher, lower rated bonds, higher yielding bonds that provide them a better return. And also on the opportunity side, if banks do tend to get the transmission out, lower rate transmission to the industry quite faster, then these spreads can come off going forward, which would mean a double whammy for investors in the sense that they would both lock into a higher rate, and also that they would see that the prices of bonds they have invested in going up. But so that would mean that selectively they can definitely look at the higher spreads, which are offering a better risk reward
True.
at this point of
True.
time.
Absolutely. Absolutely. Yes.
Thanks, Venkat. And so that brings us to the end of this conversation. I do hope that listeners have gotten a good amount of feedback. Venkat has been, like I said, he's been in the market for decades, and he has given us a very good insight into what he is bringing to the what he is bringing to his own clients, which is coming to you as listeners. Before we conclude that, I would like to mention that whatever names, issuer names we spoke about, INR Bonds is not recommending any of those investments. Issuer investors will have to do their own diligence or due diligence or work with advisors on investing in any bond. And this podcast is not for recommending any bonds for investors to invest in. It's a podcast for investors to learn, educate themselves, and take calculated investment decisions. Thank you, Venkat.
Absolutely. The
Yeah.
names I have given as all for examples only just to give a current rates what they have borrowed. It is not, investors to take their own discretion to check it with their fund managers and do the needful. Thank you.
And yeah, do follow us on our podcast channels. And Venkat, look forward to having you again on the podcast and providing any more insights going
Yeah.
forward. Thank you
Thank you
very
so
much
much.
for your time.
Thank you. Thank you.
And
Bye-bye. Bye.
yeah, thanks.